Well, good morning and welcome to the Firetrail Webinar on It's a Stock Pickers Market, generating alpha through long and short opportunities. My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle are equity partners and work alongside the Firetrail business to distribute their high conviction and absolute return funds to the financial advisory marketplace. And today, I'm absolutely delighted to be joined by Firetrail's Managing Director and Portfolio Manager, Patrick Hodgens, and their Absolute Return Portfolio Manager, James Miller. Just in terms of background, Firetrail was established at the start of 2018, whereby the whole investment team joined the Pinnacle Investment Group and set up their own funds management boutique after having a long and esteemed history of working together at Macquarie. And just on that point, it's important to note that Firetrail are exactly the same investment team with the same investment philosophy, same investment process, and even the same risk management. So today we're going to discuss how Firetrail's market neutral team are assessing the market, delivering returns, and why the Absolute Return Fund is a genuine alternate to your equities exposure. And just one point before we do kick off, whilst Patrick Hodgens and the Firetrail team probably have a bigger profile in high conviction investing, it's important to remember that Patrick ran Macquarie's Australian Market Neutral Fund during the GFC. So for today's session, all advisors have had the opportunity to submit questions prior, and with that, we've been overwhelmed with responses. So today we're going to take a slightly different approach and have our webinar structured around a Q&A format. So before we get into the Q&A, Patrick, for those attendees who are new to the Firetrail Absolute Return Fund, can you give us a really brief explanation, of what the fund does and what it aims to deliver?
Yeah, thanks, Mark, and welcome everyone to the webinar today. So the Firetrail Absolute Return Fund aims to deliver strong returns over the benchmark over the medium term. And the benchmark is actually the cash rate. So we aim to beat that cash rate by around 7% per annum. Now, most importantly, we do this by eliminating all of the net market exposure, the equity market exposure or beta from the portfolio. So yes, we're adding alpha by investing in stocks on the ASX 200, but at the same time, we're shorting stocks that we believe will underperform. So our net exposure is effectively zero. Now, so much so that the fund is totally uncorrelated to the Aussie equity market, and for that matter, also the global equity market. Now, as the table here says on the shows on the left, we have had a good quarter and a very good financial year to date. And both James and I will address that in quite a bit of detail through the presentation. And pleasingly, May is also very, very strong as well.
Okay, James, you're the co-portfolio manager. The fund is constructed to be market neutral. What levers do you use to generate alpha and manage risk?
Thanks, Mark, and good morning, everyone. And that is so important that it is genuinely market neutral, meaning that every dollar we are invested long, we have that same dollar invested short. We don't try to time the market. We always have that zero net exposure. When it comes to generating returns in the fund or alpha, there's three levers and three parts of the portfolio that we look at there. The whole long side of the portfolio, i.e. stocks that we're buying, is looking to generate those returns. So the biggest stocks in the fund are high conviction long positions, where we're looking for stocks that are cheap in the medium term, and that's really thinking about valuation out about 3 years. Also on the long side, we have our small companies and event stocks, smaller positions, but that same valuation focus. From the short side of the portfolio, i.e. stocks that we're selling, we aim to generate excess returns from our fundamental shorts. And this is where we actually put valuation to one side and all we do is look for a catalyst for a share price to fall. So think about something like an earnings downgrade or an industry structure change for a company. And finally, to round out the portfolio, we have our risk short positions, and they play a very important role in keeping that net exposure of the fund at zero every day. So there really is a diverse array of sources of returns across the portfolio. And to give you some more color on that, I'll take you to the next slide, slide 6, which gives you the shape of the typical snapshot of positions in the fund. You can see on the left-hand side there, those concentrated, large, long positions of our best ideas in the green. And then on the right-hand side, the far right there, that chart, the dark blue are our fundamental short positions. In between, those light blue short positions are the risk shorts. So those longs are equal to the shorts, and I cannot say it enough that we always have this market neutral portfolio. It's all driven by fundamental research, and that's what generates the alpha for us.
Look, as we can see on the next slide, Patrick, you also ran a similar strategy at Macquarie during the GFC. Can you run us through the role of a market neutral strategy through a downturn?
Yeah, that's right, Mark. I did manage the Macquarie Market Neutral Fund for most of its 15-year history, but most importantly through the GFC, which we have on the table on the left-hand side there. And what this chart highlights is exactly how I believe a market neutral fund should be managed. If you look at the blue line there, from peak to trough, the GFC, the ASX 200 fell around 47% over that 18-month period. The market neutral fund that we're managing that at that time trundled along and delivered what exactly on its objectives, around 10% above the cash rate. It didn't, in fact, see the GFC at all. Now, to be fair, if we extended that chart a little bit further from April 2009 to effectively December of 2009, early 2010, the equity market, ASX 200, did have a very strong bounce and outperformed by around 69%. But remembering from an incredibly much lower base. So you've got investors in equities got around half of that underperformance back. The market neutral fund over that period from September 09 to the end of that year, again, trundled along and delivered cash plus around 10%. And market neutral funds shouldn't see market downturns, but just as importantly, they shouldn't see the market bounces as well. Now, there is a but to that. You can't be a fund manager without having a few buts. And I think that's explained on page 8. It doesn't mean that the fund is immune from any short-term underperformance or negative returns. And what this table or chart shows on page 8, it highlights all of the ASX 200 drawdowns or falls, if you like, over the past 4 years. And those are highlighted in green. There's been effectively 21 negative months. And the biggest one was the one we just experienced through COVID, March 2020, where the market ASX 200 was around 22%. The blue bars next to it highlight the Firetrail market neutral performance over each of those months. Now, 60% of the time, we are up when the market is down, and it highlights that the equity market direction is absolutely irrelevant to this fund. It is totally uncorrelated to the equity market. Now, you may notice on the left-hand side that March 2020 is a pretty big number. Yes, we did do better than the market. The market was down a bit over 22%, but we were down as well. We were down around 5%. Now, much of that was due to repositioning through COVID, which I'll address in quite a bit of detail shortly. And pleasingly, we've tripled that underperformance from the positive side, if you like. So we've added over 12% by aggressively repositioning that portfolio through March. And much of the rest of the presentation will touch on that in detail.
Okay, Patrick, and combining a number of questions our clients have asked, looking back over the March period of the increased market volatility due to coronavirus, how did your team approach managing the portfolio? What did you focus on? What big moves did you make in portfolio positioning, if any?
Thanks, Mark. I think I counted about 8 questions there, so I'll try to address as many as I can. But effectively, when you get a massive dislocation like we've seen through COVID, it is all about risk management. That is the key issue, assessing the risk in the current portfolio. And we did that very quickly 3 ways. Firstly, what can we learn from history? We assessed this dislocation, COVID-19, versus history. How different or similar was it to the GFC, the 87 crash, the NASDAQ meltdown, even way back as 1929 crash? What were the similarities? Well, clearly, all of those had significant balance sheet stress, increased volatility, and too many experts, too much information and data, and really not a lot of confirmation of facts, if you like. The differences this time is we believe company management are much better prepared because the GFC was only 12 years ago. But the big issue or the big difference this time is The world has never experienced where 60% of all listed companies have seen their revenue fall by at least 50%. And when we go back to early March, companies didn't know whether this was going to last a week, a month, or even a year. And even where we are today, it still could last a lot longer than expected. So the first thing was, what can we learn from history? The second one is, how is each company and the portfolio overall positioned for a worsening of the virus? And the subsequent event to that is that, the negative implications to global GDP. So what our head of risk team member did, Justin Gray, is he created a COVID risk beta for each stock to really assess how exposed each company and the fund that we invested, that your clients invest in, was exposed to COVID. And it gave us a very important base in early to mid-February, really to work from there. But the third and probably most important thing is we got the analyst team to work. We assessed each and every company in the portfolio, and we really got the analyst team to ask 5 very important questions. We needed to answer these very quickly. The first was, how exposed is the company to COVID-19? And particularly if we get to a worst case scenario, what is their balance sheet like? Do they need to roll over debt? Are they strong enough to withstand a worst case scenario? Do they need to raise equity? And if so, how much? The second one is, how long can a company survive under a lockdown scenario? The GCC, which we call it, the global corona crisis, is very different to the GFC. The GCC is all about cash flow and liquidity. Does the company have enough or have sufficient liquidity, if you like, to withstand limited or no revenue for 12 months or more? The third point, interesting from a risk management, but also from an opportunity standpoint, the changing industry structure. Now, clearly, in our view, we are not going to go back to 2019 or 2018 anytime soon. Who are going to be the losers, but also who are going to be the winners from these changes? Clearly, travel, shopping, office work, commuting, these will all change. Who are going to be the winners out of this? The fourth one was 2 points here, the potential government intervention and the knock-on effects to that. We really wanted to steer clear of any company that was really only going to survive with continued government backing. The knock-on effects to that is, what is the end result? Increased taxes, levies, and the like. So we wanted to steer clear of companies like that. And the second midpoint there, intra point, was the recap opportunities. What are the companies that will jump early and recapitalize their balance sheet early? One key similarity from the GFC is we noticed, company management, he or she who raised early, hard, and raised enough really came out of the GFC much, much better. And we'll talk about sort of that recap opportunity, which is an opportunity for this fund a bit later. Probably finally, and the most important point is, what is already in the share price? Now, we got a lot of heat in March from some clients and a few consultants because we were buying more Qantas and we participated in the recapitalization of Flight Centre. And the question was, surely both of these companies really are at the pointy end of COVID? Well, yes, they absolutely are. But the simple question was it already priced in? And the work that we did, we were incredibly confident that it was already priced in. The market had assumed low or no revenue for these two companies forever, effectively capitalizing a worst case scenario. We were heavy buyers of Qantas at around $2.40 mid-March. And we also participated in the Flight Centre recapitalisation at $7.20. These companies now are trading at $3.50 for Qantas and $10.50 for Flight Centre. At the end of the day, the price does matter. So once we've assessed the current portfolio and the risks there, the second step is all about the opportunity COVID can present. Now, as an investor, COVID to us is a 1 in 10 year opportunity. It's a huge opportunity for us to add value for our clients. The month of March gave us that opportunity where there was 3 distinct outstanding opportunities to aggressively reposition the portfolio. We had those 3 days where we had a correlation of 1 day where all stocks got sold down incredibly heavily with incredible liquidity. Companies were sold indiscriminately during these periods, and it wasn't dissimilar to 3 or 4 experiences we had through the GFC as well. Now, on these list of companies that we have here, we either bought many of these for the first time through March or aggressively increased our position through that quarter. And pleasingly, the vast majority have added significant value through April and also through May. Now, rather than going through all 15, and we're happy to sort of take questions on some of them a bit later, I'll hand over to Jimmy Miller shortly to touch on two great opportunities. One was Afterpay, which is a very successful Aussie company, global buy now, pay later business. It's a great stock which we increased our position in March, believe it or not, at $13 a share. That company is trading at $40 odd today. And the second one that he'll touch on is Aristocrat, probably the #2 global slot machine designer and manufacturer. It was a new position for Firetrail, which we bought again mid-March at around $18.30. And that company is also up well over 50% in the last couple of weeks or so. So with that, I'll hand over to Jimmy to touch on those two stocks.
Thanks, Paddy. And Afterpay and Aristocrat were two of those stocks where we did change that positioning. Firstly, on Afterpay. Afterpay is a company that we do know well. It has been a part of the portfolio for some time. And one of the key things that we watch is its customer additions. What are the new customers coming onto the Afterpay platform? And one of the metrics we watch there is app downloads across the Apple and Google stores there. And during April and into May, what we're seeing is that Afterpay is significantly beating its peers, Klarna and Affirm in the US app download market there, which is great news. Afterpay did have a big fall, as Paddy mentioned, by the share prices there, but it's worth touching on where Afterpay is different to some other consumer credit exposures. So if you think about a credit card, what you can do there, if you come under financial distresses, you can go out and you can really extend your borrowing to your max of your credit card limit. Afterpay is actually a little bit different there. What they do is they can control on a purchase by purchase basis whether they allow a customer to get credit from them. They have a great risk modeling engine and AI analytics in the back end, and that allows them to control their customer risks in real time. So while it is something we think about a lot, it's not something we might be as concerned about as the market. And what we've seen recently with Afterpay is the Chinese giant Tencent's 5% investment, really giving validation that it is a real opportunity for us. So that's one we're quite happy to add to. The second one is Aristocrat, which we put in that quality leaders bucket there. Clearly a gaming company, and its largest market is in the US. And there's two key reasons we added this stock to the long portfolio. The first one and main one is that there is a huge opportunity for Aristocrat to gain further share in the US land-based gaming market right now. Shutdowns have had an impact on casinos, and we've been talking to a lot of these casinos as they restart their operations. And what they're telling us is that as they get back on their feet, they want to find the top grossing games so that they can maximize their revenue. And that's what Aristocrat produces. Secondly, it's the industry structure. Aristocrat's two main competitors, their companies called IGT and Cygames, are highly leveraged. They were highly leveraged going into COVID-19, and that's only increased now. Their ability to spend the same amount of money on research and development, we think will be significantly constrained now, again, adding to the opportunity for Aristocrat. And finally, as we think about with all of our long positions, valuation. Aristocrat would have been watching for a while. We were finally able to get an entry point that we wanted. So that's just two of the names there on the long side where COVID-19 has really thrown up a few opportunities, and there has been a number of opportunities in the market that have been created.
Okay, guys, look, we have had multiple questions come in on corporate activity, which has also been a real theme during the past quarter. How do you guys approach these opportunities?
Yeah, you are right. There's been a lot of recaps, and really the research we did in the early days looking at those past crashes really gave us a head start towards positioning our funds to take advantage of these recaps. If you cast your mind back to the GFC from really late 2008 to sort of the end of 2009, there was over 120 companies raised, well north of $100 billion. And we're hitting a pretty similar profile in these early days of COVID as well. So well over $20 billion of companies have raised in the Aussie market through COVID, and over 30 companies in total. So we're about a third of the way through. Clearly that'll ramp up if lockdowns get extended, and it'll probably reduce and won't be as severe recap as the GFC if the lockdowns are successful. The Firetrail team have had a very strong track record of assessing corporate raisings. We do all of this bottom up and fundamentally. We don't just sort of have a bit of a punt. It's all about that deep dive research. Generally, when you look at a typical recap, as I mentioned before, the companies that raise sufficient, raise at a good discount and raise early generally come out the better. So we did participate in a lot of these earlier recaps. And when you look at it quite simply, they're generally done at a discount. So that's a nice tick for us. Generally, you can get a fairly good line of the stock as well. So you don't have to sort of effectively pay market impact to get exposure. And when you think about it, most of the reason the share price has fallen in the last, day, week or month is because, the balance sheet needs repairing or there's liquidity issues, and a good capital raise generally will eliminate this. And that's one of the key things we get the analysts to look at. So pleasingly, we took up around 10 of these recaps and all of them are up relative to the market, and anything between 15 and 50%. Now, for the month of April, this has added 2% alone. And for the month of May, we're up around 80 to 90 basis points already in these recapitalizations. So we do expect them to continue. They'll ramp up again if COVID sort of ramps up globally, or they'll sort of start detuning through time. But there's still some great opportunities out there.
Certainly like the corporate activity has been a benefit for portfolios, and Firetrail looks like they've been selective but busy in this space. Okay, look, we have had a couple of questions coming in looking at different portfolio levers that the fund can use. So throughout the past financial year, and including COVID, guys, look, how have these performed?
Yeah, so on page 12, we've really got here the financial year-to-date alpha. And as James mentioned a little bit earlier, there's 4 broad levers or alpha drivers where we look to add value for the market neutral fund. Now, you look back through the 15-odd year history, generally speaking, at least 3 of these are working at any point in time. And it's a very rare day, all 4 sort of shooting the lights out. Pleasingly, this financial year to date, all 4 are outperforming very, very strongly, which is resulting in sort of returns pretty significantly above objectives. I think with that, I'll hand over to Jimmy and he can run through a couple of examples there. We won't labour too much, but just 1 or 2 examples on longs and maybe the shorts.
Perfect. So to pull up some examples there where we are excited about the opportunity and returns have been created in that mid to large cap long portfolio. Evolution, ticker EVN, second largest gold miner in the ASX with an excellent management team, is one we're excited about. We do maintain at the moment a net long position in gold, and we also have Newcrest at the moment in the long portfolio, which we're also excited about. In that small cap event long portfolio, MP1, Megaport, it's a stock we've held for a while. It was one that did a capital raising. We were already existing shareholders there. What they do is virtual cloud connectivity, a global leader in that. And that sounds like a bit of a mouthful, but quite simply, what they specialize in is getting data to the cloud in a cost-efficient manner. And the key thing we're watching there is how they're continuing to add to their locations around the world. And the growth rates there are fantastic. And then on the fundamental short side of the portfolio, on those top contributors, Westpac and ANZ, it became apparent to us early on in the COVID-19 outbreak that bad debts and the provisions for bad debts were going to have a significant impact on the earnings for the banks. And Westpac and ANZ were 2 of the examples where we took the opportunity to add alpha from fundamentally shorting those ones there. So that's just a few of the names, but as Patrick mentioned, right now, all parts of the portfolio have been firing really to create these excess returns right now.
Great, guys. Look, finally, guys, and no easy ones here. We've had a few advisors ask the $1 million question, what's the outlook for the market and I suppose the portfolio? Any insights you can provide there?
Yeah, sure. The market direction is very difficult to sort of estimate at any point in time. To us right now, we're quite surprised with the resilience of the market through late April and May. But this fund doesn't look at the market. It's all about sort of, we don't care the direction the market's up or down, as long as the liquidity's there and the opportunity's there. And pleasingly, we're very excited about how the fund is positioned. It's incredibly well positioned, and there's a lot of outstanding opportunities there, as you can see on this slide on page 13. What this chart highlights is effectively the embedded value or the expected or predicted alpha that we can get from the portfolio over the next 2 to 3 years. Now, we're not expecting these companies to re-rate in terms of valuation or PEs, but our analysts have conservatively forecasted earnings per share looking at 3 or more years. And if these companies trade back to their similar PE ratings relative to the market, it's all about being relative to the market, and this is the profile of alpha we should expect to get over the next 2 to 3 years. Now, the one main point on this slide is the light grey bar on the right-hand side. In my history of running these funds over the last 15 or so years, I've never seen a number much higher than 20. And right now, we believe there's well north of 30% in expected or embedded alpha in this portfolio. Now, it may take us 2 to 3 years to uncover or unravel that, but we're incredibly excited about the prospects of this fund. And right now, to us, it truly is a stock picker's market. I think with that, Mark, I'll hand it back to you for questions.
Fantastic, Paddy. James, it's been an absolute pleasure hosting the webinar with you both and to get your insights into how a genuine market neutral fund works and the opportunities you are seeing with the Firetrail Absolute Return Fund. Just in summary, the current environment has shown that many alternates have not delivered for clients. And importantly, the Firetrail Absolute Return Fund has delivered positive returns. And for the 3 months to the end of April, 30th of April 2020, the Firetrail Absolute Return Fund has delivered a positive return of 4.4% when the ASX 200 equity market was down minus 20.3%. And over the current financial year, the Firetrail Absolute Return Fund has delivered a positive 12.8% in a period when the ASX 200 equity market was down minus 13.8%. And all those figures are quoted net of fees and, as I mentioned, to the 30th of April. But I think the real point of differentiation that I find why advisors have been such strong supporters of the Firetrail Absolute Return Fund is because the fund is genuinely market neutral. It has no equity beta, and the fact that the fund is totally uncorrelated to all the major asset classes such as Australian equities, global equities, bonds, and CTAs means that it is a proven alternate to equities and cash. Look, Paddy, James, look, unfortunately, that is all the time we have got allocated today. We have had a number of questions come in throughout the presentation. We don't have time to cover those, but we certainly are happy to arrange one-on-one catch-ups with the Firetrail team to discuss further. Just in closing, for those of you who want access to Firetrail's Absolute Return Fund, the fund is very positively rated with Lonsec and Zenith, highly recommended Zenith and recommended by Lonsec. And in terms of platforms, the Firetrail Absolute Return Fund is available on most platforms. However, if you'd like to see the Firetrail Fund available on your chosen platform that's not there, please contact a member of the Pinnacle distribution team or leave a comment on this webinar. We will be making the Firetrail webinar available on the Firetrail investment website, which is www.firetrail.com, and that'll be available later today. We certainly would like to thank everyone for their participation. If you do have any further questions, or as mentioned, we'd be delighted to do any one-on-one meetings with you to go through any further detail. Please contact your Pinnacle distribution team member. Thank you very much for your time today. We certainly look forward to speaking with you on our next webinar or via a video conference meeting. Goodbye and have a nice day.